We like to think that markets are rational, that prices reflect real value. But history tells a different story. Sometimes, the biggest crashes weren't caused by wars, natural disasters, or government mistakes. They were caused by people like you and me, speculators chasing quick gains, building bubbles on thin air, and setting the stage for disaster. Speculation isn't new. It's as old as trade itself. The problem arises when the chase for profit overtakes any concern for real value. To understand the danger, we need to look back at some of the most dramatic examples in history, moments when greed and optimism combined to create massive, unsustainable wealth until it vanished almost overnight. Let's start with one of the earliest modern examples, the Mississippi Bubble in France, 1720. John Law, a Scottish financier, convinced the French crown to allow a new form of paper money tied to the Mississippi Company, which promised huge profits from Louisiana's resources. Nobles and merchants rushed in, buying shares at incredible prices. Fortunes multiplied on paper. On the surface, France looked unstoppable, but the underlying economy was fragile. Most of the wealth was speculative. It had no real backing. When confidence collapsed, those wealthy investors were ruined. Those who held tangible assets, land, businesses, and skills survived. The lesson was clear. Speculation can inflate wealth temporarily, but it can't create real value. Fast forward to the Dutch Tulip Mania of the 1630s, often cited as the first recorded speculative bubble. Rare tulip bulbs became status symbols. Prices skyrocketed to astonishing levels. Some bulbs sold for more than a skilled craftsman earned in a lifetime. People borrowed money to buy bulbs they didn't even intend to keep. When the bubble burst, the market crashed and countless lives were affected. The tulip itself had no productive value. It was a symbol, a bet on future price increases. Speculation had detached value from reality, and the collapse was inevitable. Speculation has also fueled some of the most famous crashes in the United States. The stock market crash of 1929 offers a stark lesson. During the Roaring '20s, people treated stocks as a one-way elevator to riches. Brokers offered easy credit, and ordinary citizens bought on margin, hoping to ride the wave of ever-increasing prices. Markets were overheated, disconnected from actual corporate earnings. When confidence faltered, panic spread. Stocks that had been trading at astronomical prices lost 90% of their value. Millions of Americans saw their life savings disappear. Speculation had created an illusion of wealth, and when the bubble burst, the consequences were catastrophic. Those who focused on tangible businesses, farms, or skills weathered the storm better than those who chased paper profits. Speculation doesn't only destroy fortunes, it can destabilize entire economies. Consider Japan in the late 1980s. Real estate and stock prices in Japan soared as corporations, banks, and individual investors speculated wildly. Tokyo land alone was valued higher than all of California. Shares of companies ballooned in price far beyond their earnings. The bubble burst in 1991, wiping out trillions in paper wealth. Banks faced insolvency, property values collapsed, and the economy stagnated for decades. Yet, Japan's recovery was possible because the country retained real value, a highly skilled workforce, industrial capacity, and innovation. Speculation had destroyed the illusion of wealth, but underlying value provided a foundation to rebuild. Even in modern times, speculation continues to shape financial markets, and often with dramatic consequences. The 2008 global financial crisis is a clear example. Banks, investors, and homeowners all participated in a system built on the assumption that housing prices would keep rising indefinitely. Mortgage-backed securities and complex derivatives were treated as safe, high-yield assets, even though their value relied entirely on continuous price appreciation. When defaults on subprime mortgages began to rise, the interwoven financial system unraveled. Millions of people lost their homes, their jobs, and their life savings. Once again, wealth built on speculation vanished almost overnight, while those holding assets with tangible value, agricultural land, essential businesses, or marketable skills, were better positioned to withstand the shock. Speculation creates these recurring crises because it detaches perceived wealth from actual value. Speculators focus on price movements, betting that someone else will pay more tomorrow. The asset itself may have minimal intrinsic worth. When expectations fail or confidence erodes, prices can collapse at alarming speed. The higher the level of speculative activity, the steeper the potential fall. Another instructive example is the dot-com bubble around 2000. Many internet startups lacking profits or sustainable business models saw their stock prices skyrocket simply because they were tech companies. Investors poured money into these ventures, expecting continuous growth. For a time, stock portfolios appeared to flourish almost magically, but reality eventually caught up. The bubble burst, wiping out trillions in market value, bankrupting countless companies, and causing widespread financial pain. The lesson remained consistent. Speculation can create illusions of wealth, but it cannot generate long-term, enduring value. Even today, speculation drives certain markets. Cryptocurrencies, meme stocks, and high-risk tech ventures frequently experience extreme price swings, disconnected from real-world utility or profits. Excitement and fear can move markets faster than underlying fundamentals, creating opportunities for enormous gains, but also for devastating losses. The historical pattern is clear. Whenever markets prioritize hype over substance, perceived wealth inflates far beyond intrinsic value. And whenever confidence falters, reality corrects the illusion. True financial resilience comes not from chasing the next boom or betting on price trends, but from holding assets and developing skills with enduring demand, resources that retain value even when speculation collapses. In short, wealth built on real-world utility outlasts the temporary highs of speculative frenzy. Here's a critical point to reflect on. Whenever markets rise faster than the actual productive capacity of the economy, speculation is likely at play. Prices are being driven not by real demand, but by expectations of future price increases. And bubbles, no matter how innovative or trendy, always burst. The timing is unpredictable, but the outcome is rarely kind to those who participated blindly. Speculators are not inherently bad. They can provide liquidity and encourage risk-taking, but history shows that unchecked speculation leads to crashes. The pattern repeats across centuries. Tulips, Mississippi Company, Roaring Twenties, Japan, dot-coms, 2008. Each time, markets disconnected from reality and fortunes evaporated. So what can you take away from this? The key is distinguishing wealth tied to real value from wealth inflated by speculation. Skills, productive assets, essential services, and knowledge are durable forms of value. They survive crashes, currency devaluations, and speculative bubbles. Speculative profits may vanish overnight, but value persists. If you want to avoid being a casualty of speculation, focus on what endures. Ask yourself, does this asset or investment produce something people need, or is it just riding a wave of optimism? Do I control the underlying value, or am I betting on someone else's behavior? That mindset shifts you from chasing illusions to building resilience. From history, it's clear that speculators shape markets, but they don't create lasting security. The Mississippi Bubble, Tulip Mania, the crash of 1929, Japan's bubble, the dot-com bust, and the 2008 crisis all show the same truth. When speculation inflates wealth without real backing, collapse follows. Those who understand value, not just price, have the best chance to survive and thrive. Remember, markets will always tempt you with the allure of quick profits, but true financial strength comes from assets and skills that endure. If you take nothing else from this, let it be this. Wealth built on speculation is fragile, but value is lasting. Learn to recognize the difference, and you'll be far better prepared than most. If this helped you see through the noise of markets and speculation, hit subscribe. I'll keep bringing you stories and lessons from history that can guide your decisions today and tomorrow.